It's no secret that the ULTY portfolio has changed, but are these higher quality stocks going to compromise the distribution yield? Also, should ULTY lower its yield to 40% and only distribute 40%? And how do you reinvest in ULTY? I'm going to analyze all those questions that got asked of the YieldMax team, and you're going to find a lot of good information in this video, so take a listen. So the first question that gets asked is about the outflows, and it's a pretty good question. The guy basically says, hey, ULTY's shares outstanding have declined by like 40%, meaning people are redeeming. Why is that? Mike had some technical difficulties, so he wasn't able to answer that question, but another guy from YieldMax, I think his name is Josh, gives the answer there. So take a listen.
I think the biggest piece of feedback we've seen from the community lately has been the assets under management and the outstanding shares. It looks like that there's been about a 40% reduction in the outstanding shares. So it looks like some of the, YieldMax larger investors in that fund are leaving the fund. What feedback are you hearing from some of the larger investors that are decide to kind of reduce their exposure to ULTY?
I can speak to that a bit. First of all, one thing I'll say is we're not able to see who's a large investor and who's a small investor. And honestly, like that's not something that really we take into account necessarily when we're listening to feedback from our investment community. We want to hear and value feedback from investors of all sizes. So that's the first thing that I would say. Just because you're a smaller investor in ULTY doesn't mean that your opinion or your feedback on the fund's strategy means anything less than someone who is a larger investor.
And that's certainly interesting to hear. What he's saying is whether you hold 100 shares of ULTY or 1,000 or 10,000 shares of ULTY, your opinion on it is just the same or equal to them. And I actually do believe that, because I think the loudest voice in the room on ULTY will probably be the one that's heard, and the loudest voice isn't necessarily the person with the most shares. So you think about like whoever's making the most noise on X or YouTube or on whatever social media and talking about ULTY, that's probably the feedback that they are hearing. And the fund managers have been pretty open. They basically hired Mike Khouw to talk to YouTubers, to talk to people on Twitter or X and inform them about what's going on with ULTY. So I actually do believe that, because it's not like they have a way of knowing how many shares you do have.
What I will say is that a number of changes are coming to ULTY. I don't really want to get into specifics today because they're still under debate by the trading team, and we're figuring out operationally how we want to address the promotion of the changes that will be coming to the fund. But we are seeking to, add assets to the fund and positions that, help stabilize the net asset value a little bit more. And that's something that we're hoping to discuss in greater detail in the next Spaces event, which will be next Wednesday.
And that is good to hear. And you best believe that I will be listening into that Spaces and reporting on it for you guys. But it's not just about adding assets that stabilize the NAV. So if you look at my screen, they've added assets that are not quantum stocks, that are not small modular nuclear reactor stocks, that aren't crypto stocks. Look at this. We've got Broadcom, American Express, IBM, Eli Lilly, Lam Research, and Morgan Stanley, a finance company. So they've added those assets, which are probably more stable than Rigetti ever was, or IonQ, or Strategy. The problem is, see here, they've bought 309 million all on one day. So they added, 6 positions in yellow, all on one day. So if that was a market high that day, 309 million out of a portfolio that is 1.3 billion, 22% of the portfolio was added on one specific day, and they sold 338 million on a specific day. So if the stocks that they sold, how many was this? Affirm, 2, 3, 4, 5, 6, 7. So they sold 7 stocks worth 338 million on one day, and they bought on one day. What if that was a really up day or a really down day when they sold? Like, I think they need to be cautious of that. And that was on 11/25. On 11/26, they bought 142 million. Let me highlight these. Yeah, I don't know most of these. And they sold a lot too. Not fully out of the position, but they bought 142 million on one day, sold 175 million worth of stock on another day. So over the course of 2 trading days, they traded 300 million on the 26th and 647 million on the 25th. So, 900 plus $1 million all on one trading day. But anyways, good to hear that they're stabilizing the NAV. I just think deploying 22% of the capital all at once is risky.
So I would say for now, stay tuned for more announcements on changes that are coming to ULTY. We are thinking about updating the prospectus with some new language. Not exactly sure when that's going to come, but we are, like I was saying before, always trying to be proactive rather than reactive. So I expect that you'll hear some new, updates on filings to the prospectus within the next week or two.
I think we got Michael back.
So Michael Khouw figures out the technical difficulties and hops back on. He's going to now talk more about pairwise trading, which we've talked about before when we did the last review of spaces, but it's basically saying that 2 assets that are dissimilar in industries, like I think the example he uses, Robinhood and Palantir, they both trade in the same direction, even though they're not meant to, and they're correlated because when one moves up 5%, the other also moves up 5%. And they wanted to get away from assets that were all correlated like that. So he'll explain it better than I can.
Yeah, so I guess the first thing I would say is that I think there's a relationship between the share count in ULTY and the very dynamic that the earlier speaker was just talking about, which is that we saw a significant uptick in correlation, pairwise correlations in a lot of the stocks that were in ULTY, which were not necessarily within the same industry or even sector. Hims and Hers, for example, is not the same kind of a business that Strategy is, for example, or Palantir. What those stocks did have in common was that they were high volatility, they're high beta. And I think as Bitcoin rolled over after that large liquidation that we saw in early October, and this is something we've talked about in the past, that there was a bit of an unwind that took place in some of the higher beta stocks. And so those correlations did rise. ULTY, for those who are looking at the constituents, and we publish them every night, so they're there for everybody to see, there are fairly significant holdings in things where they should remain more persistently non-correlated. So not anti-correlated, but we would expect them to be non-correlated over time.
So listen closely to what Michael Khouw is about to say now, because there's something very important. I wouldn't say hidden in what he says, but you got to pay attention closely. And it's basically this, that as they start to buy more stable assets like GLD, gold, or Google, or the TMF ETF, or Eli Lilly, the volatility on these assets is less, so they're going to be collecting smaller distributions. And he's going to use the example of Google, but he's basically hinting at that with the more stable assets, less volatile ones, the distributions might be smaller.
They will tend to have lower implied volatilities. We have some mechanisms to try to get a little extra yield out of names like that. People who have been watching have probably noticed this, but Alphabet, for example, which has been in the fund since, that was, I think it's 2 weeks now. It was, did we enter it early Friday, not this last week, but the week prior, I believe. Obviously, it's been a great performer, but it's not as high in terms of implied volatility. So for those who are looking at the fund, and those who are listening who know that there were going to be some changes as to how the constituents were selected, that you're probably going to see sort of more stability in the underlyings as a group. That That might mean that distributions come off just a little bit, but in the long run, we think that that's probably also going to, and the data suggests that would, enhance essentially the stability of the assets on which options are being written. So I would think, from my perspective, that's appealing.
So let's actually take a look at Google or Alphabet when they bought it. Let me show you the full picture of it right now, though. So they bought $55 million worth of Alphabet on the 14th of November. And since then, the stock has gone up from $275.43 to where it's trading right now at $320. So it's been a great trade for them, this Alphabet trade, stock-wise. Options-wise, though, it has not, because they've been chasing Google upwards. And you can see that because their options premium is actually negative. And why is that? Why are they losing money on the options but making money on the stock? I mean, at least they're making more money on the stock than they are on the options. But you got to look for these big negative numbers here. And the first one you see is on the 17th because Google ran up very fast, but they had a call in place that expired on the 21st of November. So they placed this trade on the 17th. The call expires on the 21st, and they sold the call at the $285 strike price. It was originally this position right here that I'm going to highlight at the very top row. That's the original position. They closed it out here, and they sold it for $2.07 in the beginning, collecting $414,000. Then they had to buy it back at $9.24 for $1.8 million because Google's stock price on the 17th shot up past 285. The 21st, on the 21st, it's trading at $300, $297, $300. Yeah, so they had to buy it back. Otherwise, they would have missed out on some of the gains. Well, they didn't have to buy it back, but they wanted to ride the gains, and they didn't want it to be, buy at 275 and sell at or get assigned at 285. So they bought it back for 1.8 million. So that's where the options credit started to go negative. Again, you see it here in this line item. Let's pick a different color. Let's go light blue there. This is an 11/28 expiration date call for $310. Here's the original one. Highlighting. They sell it for $2.59, collect $518,000, strike price $310, and they buy it back at $13.21 for $2.6 million. So their options credit is going into the negative. Thankfully, the stock's just been going up, and so they have to buy or roll these positions because they don't want to get assigned at 310. Now, this is great because they're actually making money. Total ROI is 13% on this. But if Google goes, it looks like their break even is 284. So if Google were to go down to that, they would still have negative options credit, but also not have any stock credit. So just wanted to highlight that. So when he talks about smaller options premium, if you look at how much they were going to collect, is about $318,000 on $55 million. So that is 318 divided by 55 million times -1, because I've got negative there. So 0.58%. So 0.58%, and they wrote the option on the 14th and expired on the 21st. So that's 7 days. And if you just kind of ask Google itself, what's 0.58% return over 7 days annualized, that's 35% annualized return. So definitely not enough to make those high ULTY distributions. So this is one that they're taking lower yield on from the options premium.
And I assume for most investors' perspective, especially if you're going into a diversified product like that one is, that should be a positive. There might be people who have different views about that, but we've heard from the community that that's something that's important. I think we've heard from some investors that I haven't spoken to personally, but I know that Jay and Scott and others have spoken to them. And because I know what this ULTY process now looks like in terms of stock selection, I think people should probably be, looking at this as an opportunity. That's just my 2 cents. It happens, of course, to adhere to my philosophy about how strategies like this should be constructed. And we'll see whether they respond positively to it or not.
So the next question comes from a guy named CryptoFit, and he asks kind of a weird one where he says, is there ever a chance that ULTY becomes a target 40 fund? And if you're not familiar, YieldMax has target 12s and target 25s, where they aim to distribute 12% or 25% yield. They're usually, I think, around single stock ETFs, although I think there might be a bundle of them as well that have multiple stocks or positions within them. So kind of an interesting question, but Michael Khouw shuts that thought down pretty quickly. ULTY is not going to become a target 40 fund.
I love being on this. The more I've even changed my investing strategy positively, not because he gives advice, just because I like the way he thinks. Is there ever a chance that a change in perspective from ULTY could maybe lead it to being a target 40 fund? For some reason, it seems like that is the number where it comes to extremely high income with a chance. I don't know how you guys would go around that, but has there been ever any talk about that?
There hasn't been any talk about changing ULTY per se. That is not to say that we wouldn't be interested in potentially launching products that, sort of meet the need. One of the things that I think is interesting about, the options-based high distribution ETF space, it is still very much in its infancy. Part of what clearly resonated with investors when they were first launched was high rates of distribution and maximizing them. And if you structure them in such a way that you are selling very short-dated options, a couple percent out of the money, you own the underlying assets or a proxy for them, and you intend to distribute either the capital gains if and when you receive them, interest if and as you receive it, or options premium if and as you receive it. That's going to maximize the distributions. But there's a lot of people, I think, who have looked at this and said, I think there's an opportunity here to build an investment portfolio that has, a combination of capital appreciation as well as, higher distributions. Now, the target 12s, which were launched, their asset growth suggests that that was not the sweet spot. I look at something like Biggie, I remain perplexed as to why that hasn't attracted more assets. Now we have a handful of target 25s. I think we are working towards finding that balance.
And the next question is read out by the host of Wolf Financial. It comes from apparently a longtime listener, so maybe someone who's held ULTY for a while. But the person's asking if it's possible to have a brokerage firm automatically reinvest dividends or drip them, which, yes, it's very possible. Most brokerage firms do it. I don't know of one that doesn't. I'll even throw up screenshots of how to do it on Robinhood. It took me like 10 seconds to figure that out with a Google search. So I just thought this was crazy that someone is invested in ULTY and wants to drip dividends automatically, but doesn't know how to do it and has to ask the YieldMax team how to do that. That just seems like crazy to me, but I'm not trying to be mean here or anything like that. It was when I heard that, it kind of blew my mind that this is the question that's being asked on this call, but let me know what you guys think.
I got a question from some of the audience members, one of our longtime listeners here. He said, I'm interested in hearing if you guys have considered enabling or offering dripping at the NAV for your ETFs for the brokerages that support that. Seems like a great way you could increase your competitive edge. Michael Khouw, Josh, you guys got any thoughts on that one?
Josh, you're the one that has the relationship with the hoods of the world.
Yeah, so let me just clarify the question. So it's just saying like an automatic reinvestment strategy?
Yeah, for any brokerages that support that. I'm curious. Yeah, I guess that's what it would be. That
I
makes sense.
mean, I think that it's really up to the investor to decide what they need the income for, right? A lot of people who invest in YieldMax funds use that income for various different reasons, to pay bills or to put into a um, different type of investment. I know that one thing a lot of people do is invest into YieldMax funds and then use their income to buy an S&P 500 fund. It's really up to what your risk tolerance is and what you need the income for. So hard for me to say like that's you know something that we suggest, but certainly if you're looking to accumulate a larger position in any of our funds and get the best cumulative total return that you can achieve from a certain position, doing an automated drip strategy through a broker like Robinhood, or I think that's something that pretty much every broker that I've ever used offers, um, certainly is a good strategy if you're looking to accumulate a larger position in one of our funds.
And finally, we get this comment, not really a question, from someone who I think is definitely a YieldMax diehard here, holds YMax, I think holds ULTY as well. And I'll let you guys kind of listen and see if you can hear the moment that kind of, blew my mind.
Awesome. Yeah, thanks. Yeah, I don't really have much other than the fact that I'm still in YMax and I'm waiting for a better moment to enter in. I think that we've seen some struggles in the broad markets recently, where it's been like what, a whole week or two of a downtrend in the indices. So I'm not surprised. Every fund follows it, right? So if the market's going down, so will the other funds. I'm not sure why people are complaining about ULMax products when the markets are going down.
Really? You're not sure why people are complaining about YieldMax products going down when the overall market is going down? Look, I don't want to be mean here. I don't know the guy. He sounds well-intentioned, but seriously, I think the reason people are complaining, the reason people are frustrated is that the underlying holding picks have been very bad and they've not traded them well. There have been picks where they've lost money on the options and the stock as well. They've, not been selective or screened these picks very well, and they've ended up with, quantum computing. They've ended up with, all the losers that I highlight. Let me go into it. I've got the tracker. I've got the dashboard. SoundHound, Rocket Companies, Hims, Lucid, BMNR, Fig, MP Materials, Pony. All of those have lost over 10 million. So I think that's where people are frustrated, and they haven't taken that many wins. And we can compare. I'll throw up a comparison on the screen between ULTY and the overall market, and you'll see where the frustration lies. Because even when the market is down, ULTY is far more amplified to the downside, which, is inherent in some of the picks, but there's supposed to be that offsetting option strategy that cushions the blow. Because if they're buying puts as well, that should limit their downside. But the downside, is not being limited because we see these stocks down 14% in one day. So look, I do think ULTY is getting better, but absolutely investors in ULTY have a right to be upset. So when this guy says he's not sure why people are complaining, recommend he check out the comment section on some of my videos, and he'll get a better understanding of why people are frustrated with ULTY.
Like, you can't have income products go in price when the markets are down. So yeah, and I'm actually excited for the reverse splits just because it keeps the maintenance requirements for ULTY and YMax and all that other funds at an optimal level. So for people that are margining in or have some sort of margin, they can still, I guess, keep their strategy, right? I would assume. So yeah, I honestly don't see what the problem is. The dividends that they pay out is adjusted by the same factor too. So yeah, so happy to see what comes up in the near future. But yeah, I'm actually excited for this change. And I also see ULTY change a little bit for the holdings too. Seems to be more heavy hitters now instead of speculative stocks. So hopefully this will carry, the fund itself towards a brighter future.
So this is where I actually agree with the guy that I am excited to see what ULTY can do in the future with, as he termed them, heavy hitters instead of the speculative stocks. I want to see how they trade Google, Eli Lilly. I wish they had held on to Costco, but I'm excited. The GLD trade I like, Meta I like, Broadcom, GDX. So I am excited for what the future holds for ULTY. Haven't bought in yet, but look, I don't think it's smart to go on margin and own ULTY. So I'm not necessarily. But look, I as far as the reverse splits are good because now you can margin more ULTY. I don't like using margin. I've never used it. I don't frankly understand why someone needs to use margin. But if you do use margin, let me know. What are the benefits and risks and rewards for using margin? And is that risk reward ratio really worth it? I don't know. So let me know, guys. Hope you enjoyed the breakdown and analysis, and see you in another video.